Hello and welcome to my channel, The Quality Investor. On today's video, I want to discuss my investment philosophy and the metrics that I typically look at as a high-level scan before I deep dive into a business that I want to own. To begin, let's start with my investment philosophy. This will give you some color as to the types of businesses I want to invest in on this channel. I focus on buying high-quality businesses at a fair price. Most high-quality businesses will be trading at a very high PE ratio. For this reason, I do not focus relentlessly on the PE ratio. However, I do use it as a barometer for comparing to other businesses in that same industry. But once I do buy a stock in a business, my ideal hold period is forever. I am very influenced by the Warren Buffett and Charlie Munger school of investing. My other major influence is a man named Terry Smith. He is considered the Warren Buffett of the UK. If you know the background of these three men, you know that they focus on rock solid businesses with extremely wide economic moats. So, before revealing these metrics, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, hit that notification bell so you can know right away when I post more stock analysis content. I prefer businesses that are low in cyclicality as well as having reasonably predictable streams of revenue. Therefore, I avoid sectors such as basic materials and energy because they are at the mercy of commodity prices. I'm also keenly aware of my own circle of competence. I do not understand utilities or banks and most of the industries within the communication and healthcare sector. This narrows my focus down to the consumer cyclical, consumer defensive, industrial, and tech sectors, as well as a handful of remaining industries within the financial and healthcare sectors. So, what metrics do I use to even begin dwindling down the still vast amount of businesses that remain in these sectors? Pop investing culture and the mainstream investment news love to focus on revenue and earnings per share growth. While those are important, they don't even come close to describing the quality of a business. There are just so many examples of a business missing on their earnings per share estimate by only a few cents, and the market sends them spiraling down 10, 15, or even 20% in a single day. The upshot to that short-term volatility, however, does mean some very fundamentally sound businesses will be at a discount, albeit shortly, once the market recognizes they overreacted. To identify a really high-quality business, the metrics I like to focus on are margins, specifically gross and operating margin, returns on capital, such as invested capital and capital employed, and free cash flow metrics. Please note, I do not use these metrics as a be-all end-all for my investment choices. I simply use them as a guide to identify businesses worth doing a deep dive. For margins, I like to look at gross and operating margin. I don't necessarily focus on high margin businesses. However, I want to see margin expansion. Businesses where the margins contract over time are dying businesses. When a business's gross margin is expanding, it's demonstrating that it has pricing power in the market or leverage over suppliers, things of that kind of nature. When operating margin grows, that means the business is becoming more efficient in managing its overhead. Maybe they cut an unprofitable business line, or they found ways to increase employee productivity. A business can only grow and increase profitability over time if management is effective at allocating capital. That's why I like to focus on return on invested capital as well as return on capital employed. These two metrics show management's ability to allocate capital effectively and generate growth and return for investors. Over the long term, a company's return in the market will generally converge with its return on capital. All quality investors should want high free cash flow. As an owner of a business, what we care about most is how much cash that business can put into our pocket. Free cash flow is used to pay dividends, buy back shares, or put money back into the business for growth. I like to look at free cash flow per share, free cash flow margin, and free cash flow conversion. Free cash flow conversion is for every dollar of net income, how much of that is converted into free cash flow. What you're looking at here is a custom stock analysis file I've been building to help me compare businesses using these metrics. So the stocks that you're looking at here are actually all 18 stocks that make up my portfolio. So before I even consider owning a stock, I at least want to look at all these metrics at a high level to see if it's worth diving into on a deeper basis. So what we're looking at here is this is the top table. It's 10-year compound annual growth rate, and I can switch that growth rate period to be a 1, 3, 5, or 10-year rate. And down here, these are an average of a few of the metrics that I like to look at as well. So you can see we're looking at a 10-year compound annual growth rate, and starting out, we're looking at revenue per share. I like to look at per share data on a few of the metrics because it normalizes the data and it makes it easier to compare across various businesses. So in this case, you can see all the businesses I own have a fairly decent revenue per share. My baseline is about 10%. You can see here, however, that not every single business that I own has grown their revenue per share at 10% over the last 10 years. But it's important to keep in mind that these aren't hard and fast baselines. They're merely a guide to start looking into. And there could be reasons why you'd want to buy something even if it's not growing at the rate that you ideally want it to see grow at. For example, Costco and Coca-Cola and McDonald's, these are great, wonderful businesses, even though they might not have grown their revenue as fast as, say, a Tesla or a Fortinet. But like I said earlier, revenue per share, it's a good thing that a business grows their revenue. Obviously, that's what they have to do if they want to have any hope of surviving. But it's not my real first thing that I really, really need to be great. I like to look at gross margin and operating margin. Now, this isn't the actual gross margin of, say, Applied Materials, 1.6. You can see their actual gross margin, the average over the last 10 years is 44.4%. This is how much they've expanded their margin annually in the last 10 years. So for Applied Materials, they've expanded their gross margin by 1.6% per annum over the last 10 years, and they've expanded their operating margin 10.7% over the last 10 years per year. You can see their operating margin, their 10-year average operating margin is at 24.56. So that's the 10-year average of the operating margin. But if I look at it on a one-year basis, so basically what the most current margin for Applied Materials, it's at 28.86. So you can see what I mean here by expanding that margin. They've averaged 24% over the last 10 years, but the last fiscal year, they did 28.6 at operating margin. So not every business that I buy is going to have a margin that expands. Like if you look at Microsoft, for example, they've had a slight 0.68 decrease per year in their operating margin over the last 10 years. However, there's a lot of other reasons why Microsoft's worth buying, not just in margin alone. You have to think about these in terms of how they holistically all play together, not just in isolation by metric. What I don't want to see are businesses that have had very sharp declines in margins over the last 10 years or even the last couple years. That to me is indicating that they are losing market share or their economic moat has been breached in some way. So coming over to earnings per share and free cash flow per share, again, I have about the same criteria as I do for revenue growth. About 10% is ideally what I like to see as a minimum for the businesses I buy. But again, it's not the end of the world if they don't have it. McDonald's doesn't have that sort of growth, but McDonald's has easily beaten the S&P over the last 3, 5, and 10 years. So looking at free cash flow margin, for example, I want to see that expanding as well. That shows me that the business is doing a better job of managing their cash from operations, or maybe they're not investing as much in CapEx as they had to historically to continue to grow. So a free cash flow margin, if that's expanding, that's another very good sign. Looking at dividends, this is another thing I like to see. It's not a requirement for me to have a dividend stock. However, I don't want to see dividends that are really low. Like 5% dividend growth is actually not great here for Coca-Cola. Anything less than about 5% per year dividend growth, you run the risk of inflation eroding your actual purchasing power for those dividends. And I'll show some examples shortly of metrics that just look terrible for certain businesses. And one of the other things I like to look at here is shares outstanding. Share buybacks are always a good thing. That rewards shareholders and it reduces the amount of shares outstanding, thus increasing the amount per share for things like earnings and free cash flow. On an average basis, this is where I get into return on invested capital and return on capital employed. To me, these are some of the most important metrics to consider when you're buying a stock. And I want to see about 15% minimum on return on invested capital and about 20% minimum on return on capital employed. These metrics really show how effective management is at deploying the capital that they receive from things like debt, stock offerings, as well as retained earnings. As an investor, you want the managers that are running the business for you deploying capital in such a way that it's towards highly profitable and highly growth-oriented projects. And like I said at the beginning of the video, a company's return in the market over the long term will always converge with their return on invested capital and return on capital employed. So high returns on capital and you'll get high returns in the market over the long term. But it's very important that you hold these stocks for the long term. Money is made in the market by holding and allowing your stocks to compound over time, not by trading. And then I also have 10-year averages for gross margin and operating margin and the free cash flow margin. You can see, like I said earlier, I don't always focus on high margin businesses. Costco, for example, has an operating margin of just over 3% and a free cash flow margin of 2.2%. However, they're very good at deploying the capital they do have. You can see that their return on capital employed is at nearly 28%. So high margins don't necessarily mean it's a bad business. It's what they do with the money they do earn that tells the story of what the return might be for you. And here, looking at free cash flow conversion, this is how much of net income is converted into free cash flow. For Apple, for example, every dollar of net income, they convert into $1.14 of free cash flow. I like to see free cash flow conversion at about 90 cents minimum when I'm evaluating businesses. The next metric is CapEx as a percent of net income. So how much of net income, how much of that are they using for CapEx? Because I like to look at capital light businesses. Capital light businesses don't have to invest heavily in capital expenditures to continue their growth or maintain what they already do. A good example is Visa and MSCI. You can see that Visa, they spend about 7.4% of their net income on capital expenditures, and yet Visa is a compounding machine. MSCI is also a good example. 13.4% is spent on capital expenditures, and yet MSCI just continues to really grow and outpace the market. So you can see, if I scroll down to the bottom, my portfolio average, at least over the last 10 years on all these metrics, is I think pretty decent. So I have an average of ROIC of 17.2%, 22.8% for ROCE, and so on. You can look at these here. But another thing I want to point out, Photronics, one of the businesses that I really do love actually, they have a free cash flow conversion of 63 cents for every dollar of net income. Now, I know I said I like looking at businesses where the minimum is about 90 cents. However, this brings me to another point, which is I'm looking at a 10-year average right now. But I want to make sure over time, this number is also increasing. Well, all these numbers are getting better. So if I look at it on a 1-year basis, I can see Photronics last year, they did $1.37 in free cash flow conversion. And a lot of the other metrics improved as well. So you can see on just last year, my entire portfolio is now at 28% ROIC, 30.6% ROCE, and they're over 50% gross margin, over 30% operating margin. All of these are drastically improved from 10 years, their 10-year averages. So it's not just a single point in time where these numbers matter. Like I said, you want to take all this in holistically. It's over time. Are they improving, continually improving on these metrics? So now I want to do a comparison of two retailers just to show you how some businesses are actually pretty terrible in their fundamentals. So here's Ulta Beauty and Walgreens. I own Ulta Beauty. It's one of my favorite businesses. They're excellent retailer. And Walgreens, who is a member of the Dow Jones Industrial, and as well as, correct me if I'm wrong, they are a dividend aristocrat. And you can see here over the last 10 years, they've only grown their revenue at 7.8% per year. They've lost a lot on the gross margin. Their gross margin has contracted 4% annually over the last 10 years. They have a 0% operating margin, which means it's actually negative. And then same with earnings per share. And then their free cash flow per year over the last 10 years has contracted 25.8%. Walgreens has also grown their dividend only at 5.35% over the last 10 years. Remember, this is all 10-year compound annual growth rate. And on an average basis, you can see just how terrible some of the other metrics are. They've only returned 6.65% ROIC, and then ROCE is 11%. And Walgreens' return in the market, annualized over the last 10 years, is a negative 4.5%, and that includes dividends. So note some of these numbers here for Walgreens before I flip over to the 1 year or the current year numbers. Gross margins at 23.3%, operating margin at $250, free cash flow margins at 3.5%. This is their 10-year average. Free cash flow conversion $1.90, and then CapEx at 54.7% of net income. If I look at what they've done just in the most recent year, Walgreens has a negative 4.5 return on invested capital. Their gross margin has fallen from 23 down to 19.46. They have a negative operating margin. They barely have a free cash flow margin that's positive. And because they posted a loss, they're not even generating free cash flow. Ulta Beauty, on the other hand, is the exact opposite of what Walgreens is doing. They now have ROIC at 37% and ROC at 40%. And just for reference, their 10-year stock return has been at 17.7% for Ulta. Remember, their 10-year average is at 26.4 and 30 for ROCE, and they've grown that return on their capital. So the management is getting better at allocating their capital. Margins, just last year they did 39.62%. Their 10-year average is at 35.9%. Again, Ulta is demonstrating what a quality business is, especially when you're comparing it with a business that's really been struggling over the last few years. And another thing to note here, like I said, you want to see dividends, at least 5% annual growth there on dividends. That keeps at least pace with inflation. But due to Walgreens' struggles, last year, they only increased their dividend by 0.37%. And remember, Walgreens is a dividend aristocrat, and they want to retain that title. But they're only increasing their dividend. They only increased their dividend last year by 0.37%. Shareholders of Walgreens are effectively losing purchasing power on those dividends. If you're an older person that's maybe relying on dividend income for retirement, Walgreens is really letting you down because you're losing purchasing power with Walgreens' very marginal dividend increase. Well, that's a high-level overview of the metrics that I like to look at when I start to screen for high-quality businesses. And if a business passes all my screens, then I'll really dig into that business and assess if it truly is a high-quality business. And before we go, I do want to remind you that this is not financial advice, and I really encourage you to really focus and do your own research into businesses. With that, thank you for watching today's video. And what sort of metrics do you like to look at? Please let me know in the comments below. And lastly, please hit that like button. And if you found this info helpful, please consider subscribing to the channel and joining our community. Thank you and happy investing.